Is your stock about to get crushed because of what hedge funds are doing? Most traders see institutional buying in a Form 13F filing and think they have found their signal to get in, but they're only reading half the story. In the next 6 minutes, I am going to show you both sides of this filing. And the side nobody talks about is the one quietly destroying retail portfolios right now.
This is where you will get the truth, not clickbait. Watch until the end to get the pro tip.
Let's start with the basics. Form 13F is a quarterly report that every institutional investment manager must file with the SEC if they manage over $100 million in assets. We are talking hedge funds, mutual funds, pension funds, the big money. They must file within 45 days after the end of each quarter. And these filings are public. Anyone can pull them on the SEC's Edgar database for free. What do they show? Every long position that institution holds, stocks, certain options, warrants, and convertible securities. This is how retail traders get a window into what the smartest money in the room is doing. Sounds perfect, right? Here's where it gets complicated.
This one is a trap most traders fall right into. That 45-day filing window is not just a technicality. It is a trap for traders who do not understand it. Think about this. A hedge fund buys a position in January. They do not have to report it until mid-February at the earliest. By the time you see it, read it, and act on it, that fund may have already sold half the position. You are looking at a photograph of where they were, not where they are now. This is one of the most important things to understand about 13F filings. The data is always old. It tells you what big money did, not what big money is doing right now.
Number 3. Now let us talk about the 4 green sides of the coin. These are the signals that can actually push your stock price higher. First, a new institutional position. When a major fund takes a brand new position in a stock, that is a legitimate bullish signal. They did their research. They liked what they saw. And when other institutions see that filing, some of them follow. More buyers, higher price. Second, increased holdings. When an institution adds significantly to an existing position, not just a small top-up, but a meaningful increase, that tells you conviction is growing. They are not just holding, they are doubling down. Third, multiple institutions buying the same stock in the same quarter. This is where it gets powerful. When you see 3, 4, 5 funds all entering or increasing the same position in the same quarter, that is not a coincidence. That is institutional consensus, and price tends to follow. Fourth, low float plus institutional accumulation. When a stock has a small float and institutions are accumulating, there are fewer shares available in the open market. Demand goes up, supply stays tight, price moves up fast.
If this free education is helping, hit like, share, and subscribe right now. Follow Alpha Breakout Lab for free stock alerts every week. If you want to protect your money, keep watching. Most channels skip this part entirely. Here are 4 things to be aware of. First, we need to talk about warrants. Think of them as coupons that give the holder the right to buy shares of a stock at a fixed price in the future. When a 13F shows warrant positions, that is a red flag. When those warrants get exercised, new shares flood the market. More shares, same demand, price drops. And here's what makes it worse. Warrant holders will often short the stock in the open market and then cover by exercising the warrants. This creates a ceiling on the price. The stock tries to run, and they push it back down. Second, convertible notes. That is when an investor loans money to a company, but instead of getting paid back in cash, that debt converts into shares of stock. When those notes convert, new shares are created and existing shareholders get diluted. The more dilution, the lower your percentage of ownership, and the lower the stock tends to go. Third, institutions reducing or exiting positions. If the same fund that was buying last quarter is now selling, that is a warning. Especially if multiple funds are cutting at the same time. That is the smart money heading for the exit before retail figures it out. Fourth, rising institutional ownership on a falling price. This one is tricky. It can mean institutions are accumulating on the dip, which is bullish, but it can also mean they are averaging down into a losing position before eventually exiting at a loss. Always look at whether the price trend confirms the accumulation or fights it. The rule is simple. Do not just look at who is buying. Look at what they are buying, what else is in that filing, and whether the stock structure supports a price increase or is set up to dilute you.
Here is your pro tip. Before you buy any stock based on a 13F filing, go to Edgar and look for any S3 shelf registrations or 8K filings from that same company around the same time. If institutions are buying, but the company just filed a shelf registration to issue new shares, that is a conflict you need to resolve before you put money in.
Form 13F is one of the most powerful tools available to retail traders, but only if you read the whole thing. The green side can tell you where big money is building positions. The red side can save you from walking into a dilution trap that will cost you real money. If this video helped you see something you did not see before, hit that like button and share it with a trader who needs to hear this. Subscribe to Alpha Breakout Lab for free stock alerts and real education every single week. And drop a comment below. Have you ever been burned by a stock that had institutional buying but still dropped? Tell me what happened. Builders don't sleep until the dream is real.